When is the best time of the year to retire? Now, the real answer for many is as soon as you are able to retire is the best time regardless of what month of the year it is. But in this video, I want to cover 5 things or categories of things you should consider to get a little extra juice out of your retirement timing. Let's get into it. Consideration 1 is more non-financial, and that's considering what season you are retiring into. This is especially a top of mind consideration for those that live in northern states. Retiring can be such a large life transition, and I think it's really wise to do everything you can to build some momentum early in retirement. For instance, when we are a more local advisor here in Wisconsin, I continually notice those retiring in late spring or early summer had a lot easier time than those retiring in late fall. As winter came to those late fall retirees, many found themselves with an abundance of time, but a scarcity of things to do with that time. That being said, there's no absolute right season to retire into. Maybe you have a lot of winter things you love, like downhill skiing, snowmobiling, or just sitting in front of a fire with a good book. Maybe the start of winter is great in that type of situation. Or maybe you live in Arizona and retiring during winter where temperatures are milder makes the most sense. Now, the other considerations we have on this list are more financial related, but I don't think we should discount this important non-financial factor. The more momentum we can build early in retirement, the better. Number 2, healthcare considerations is a big one, especially for those retiring before 65. Continuation coverage from work, otherwise known as COBRA, is a benefit that is set to last 18 to 36 months. For covered employees that retire, COBRA lasts for 18 months at a minimum. Say you are 63 on the dot. Retiring now means you could use COBRA for 18 months, but then you need to figure out another option for the last 6 months until Medicare. This can be problematic, as we will discuss. Some retirees might find it easier in this situation to extend working another 6 months, so COBRA fills that gap fully, assuming COBRA is the best option in the first place. Affordable Care Act insurance is another huge planning consideration, but the takeaway is quite a bit different here. So when looking at ACA insurance, the amount you pay on a monthly basis, as well as cost sharing on the back end, is tied to something that we'll refer to as your reported income. Now, without diving too much into the nitty-gritty, just for the sake of time, of how ACA insurance works, effectively the lower your income, the bigger subsidy you will earn. Now, a healthcare subsidy can be the difference between a plan that costs tens of dollars per month to more than $2,000 per month with no subsidy. A subsidy is obviously a big deal. Now, many retirees can strategically manage their assets in a way where they take from Roth and taxable accounts and artificially keep their reported income very low while still living on a high income. Given this general structure, there can be a problem with working part of the year. Say you retire in July and have 6 months worth of earnings totaling $80,000. Even if you took all of the income for the rest of the year from Roth and thus kept your reported income at $80,000, you still have to report those earnings to ACA, which means you are paying quite a bit more for health insurance because of working those 6 months. Work later into the year and the situation is even worse because your subsidy will be that much lower. Given this, it's much more complicated and difficult to save on healthcare costs when switching to ACA mid-year. Retiring early in the year or even way late in the year where you barely have any months on ACA can help minimize this concern. Here's another healthcare consideration for those subject to IRMAA. For those that don't know, IRMAA is a Medicare penalty for showing too much income. Effectively, Medicare raises your cost because, quote unquote, you can afford it. There are multiple levels of IRMAA, but each threshold you hit raises your cost by $1,000 or more per person for that year. The complex thing about IRMAA is it's a 2-year look back. So say you retire this year and are 63. Well, the income you show this year will determine what you pay for Medicare in 2026 when you are 65. But here's the good news. When you go from working to retired within the 2-year look back period, you are able to appeal IRMAA penalties because of one of 6 qualifying appeal reasons. In this case, that qualifying event is retirement. What Medicare will effectively do is they'll look at the income you earned from your job and effectively subtract that income out from the calculation. This doesn't mean you won't have any IRMAA if you performed a big Roth conversion in conjunction with that earned income, but it does mean they will leave off that working income. Well, there's some ways we can use this to our advantage. On the screen, I have an estimate for the first IRMAA threshold in red. Through running this couple through a forward-looking tax plan, we find that we want to max out the 24% bracket for the next 2 years if possible, which gives us a target income up to $413,000. Then this couple is earning $22,000 a month combined while working. If we had a goal to avoid IRMAA but maximize conversion room, How long should this couple work given that we know we can appeal this year's earnings out of the equation? What is the answer? 9 or 10 months. In both cases, this would allow them to earn as much as possible while still maximizing their conversion while still avoiding IRMAA, because the appeal is designed in a way where that working income is excluded. Really, just the conversion would count here. As you can see, that conversion would be kept under the IRMAA threshold. Now, some couples might find the conversion room more beneficial and should take 1 or 2 IRMAA penalties and actually work less. But I think this is a good way to straddle both goals of earning quite a bit or earning as much as you can while also simultaneously maximizing your Roth conversion and then avoiding that added Medicare charge altogether. Consideration number 3, retirement account contributions. If we're going to work any part of the year, it's worth considering if it makes sense to max out the retirement accounts available to us. Now, most retirement account contributions are only allowable up to 100% of the employee's compensation. But keep in mind, you can often make 100% contributions of your working income to your plan. Here we have a retiree with $1 million in a taxable account, and while working, they're earning $16,000 per month. Now, they can retire January 1st, but this would rule out any retirement contributions for the year. Instead, what if they retired at the end of February? For the first 2 months, they contribute 100% of their salary to their Roth 401k. And for the sake of easy decision making, we're deciding to contribute to Roth instead of the traditional side. Now, obviously, during these 2 months, they won't have any money to live on because they're contributing 100%. So they spend from their taxable account in place of spending their paycheck. What have they done here? In an indirect way, they contributed money from their taxable account, which is a leaky bucket, to their Roth 401k, which is a tax-free bucket. They also likely got a company match in the process. By maximizing account contributions in the year they retired, they got a little more juice from their job by using the tools at their disposal. Number 4, tax implications. Now, tax implications are a really broad category, as there are a lot of things that fit here in terms of considerations like capital gain harvesting, Roth conversions, withdrawal planning, and more. However, the overall concept covering all of these topics is quite simple. The later in the year you retire, the more difficult it is to make big tax moves in the first year of retirement. Say you retire at the end of October. Well, you basically work the full year by working nearly 85% of the year. Depending on your earnings and Roth conversion targets, you might rule out conversions completely because your working income is filling up all of those lower brackets and potentially even all of your conversion room. Now, if you're in this situation, it is what it is. Don't panic. 1 year worth of Roth conversions is not going to make or break your plan, but it can affect how much juice we can squeeze out of those conversions. If this person had the ability to retire earlier in the year, it would be beneficial to do so and open up a lot more options. Then finally, consideration number 5, work considerations. There are a lot of considerations that can fit into this group, like bonuses, stock options, vacation time, and more. If you review your employee handbook, many of your company benefits are based on being employed on a certain day. For instance, you might earn your full vacation for the year if you were employed on January 1st. You might qualify for your annual bonus if you were working on May 15th. Stock options might vest or your pension might increase if you work past your employee anniversary date. Now, some of these might be small benefits that really aren't worth adjusting your retirement date off of. For others, there may be certain milestones or benefit dates scattered widely enough throughout the year that we could theoretically always make a case to work another month or 2, and then we get into this revolving door. In these cases, work considerations are a smaller variable, but sometimes the benefit you gain from working through a qualifying event can be substantial and might make it a no-brainer to work just a little bit longer. The tough thing here is every company handles their policies slightly differently. You need to look through your employee handbook or compensation package, then work out the added benefits as well as the opportunity costs. But don't just retire willy-nilly without at least considering this variable and the others discussed here. Hopefully this video gave you some great ideas and strategies that can help you, again, squeeze a little bit more value out of the time of the year you retire. If you are looking for help making this decision specifically for your situation, we have our team's contact info in the description below, and you can reach out to get some help. Also, if you're considering retiring but not sure if it's the right decision for you right now, click on this video right here where I talk about 8 reasons why right now is actually the best time to retire. Click here to learn more, and always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.